Hi, my name is Ethan Goodrich. I'm a real estate agent here in Boston, Massachusetts, and I'm starting a new educational series called Real Estate Analytics. Today we're going to break down what a rent versus buy scenario looks like in the city of Boston. So this is something I've always wanted to do and break down the math behind real estate decisions. So for this example, we're going to assume that you're renting a $4,500 apartment, which would cost you about $1 million to buy, which is pretty true. It's pretty accurate to today's climate. Okay, so first we're going to start out with some assumptions here. You're a married couple, you have a 25% effective tax bracket, the rental market and sales market are both appreciating at about 5%. The assessed tax value is equal to the actual market value, which usually is going to be trailing the true value in Boston. And this is a 2-bed, 2-bath. Okay, so first to start is the rental costs. You have a $4,500 month payment. Your utilities are $300, and you have insurance, a renter's insurance of about $200 a year. In addition, you're going to have a broker fee for that first year. That's not going to happen every single year if you stay in the same place, but that total cost for the first year is going to be about $59,000. As you can see, there's a $3,000 tax rental write-off in Massachusetts. Now, it's a lot lower, the write-off for a rental, than it is for a sale. They only let you rent $3,000. They only let you write off $3,000 max when you're doing a rental, which works out to be about a $750 savings if you're in this 25% tax bracket. So as you can see, as you combine the cost from year 1 to year 2, you'll see how much you've paid in rent and the total tenancy you've been there. So 59, 121, 187, 255. And oh my God, at the end of year 5, you've now paid $327,000 in rent. Now, was that worth it? We're going to look at what it looks like to buy a place, and you can make that decision at the end. So for buying a place, there's a little bit more involved as far as fees, costs, and important metrics to break down. So that $1 million place, we're going to assume you're going to do a 20% down payment. So that's a $200,000 down payment. You're financing $800,000, and we're going to do a 30-year fixed rate interest rate of 5%, and your total monthly payment is $42.95 here. Okay, so in addition to your mortgage payment, you're going to have some other costs as well. The big one being the taxes. So the taxes in Boston are 10.67% of the assessed value. Now that assessed value is what the city thinks your property is worth, and why that's important is because your annual taxes are based upon that. So in Boston it's 10.67%. In other cities and towns it's less or higher. In Cambridge and in Massachusetts it's the lowest. The other thing is if you're an owner-occupant in Boston, you're going to see that there's a residential exemption, which is deduction if you owner-occupy the property. This year it's $3,300, so that $11,203 tax burden at the end of year 1, which is based on that $1,050,000, $3,300 is going to come off of that, and you're going to end up with $7,898 due for the year. Now that residential exemption will go up, and your taxes will go up if the market appreciates. And you'll see what your total tax burden is down here in this line. Additionally, you'll have HOA fees. HOA fees can be from $50 all the way up to $10,000 a month, depending on what's included with the home and with the condo. But standard is $200 to $500 or so a month, including your water, your common electric, some master insurance, and then if you have other things like landscaping or doorman, it can just go up from there. It just really depends on how many services that building has. So you'll also have a condo homeowner's insurance policy. And with a condo, they call it HO6. So that's about $600 a year, maybe $50 a month. And just depending on the property value, the size, and what items that you want to include in that policy. Same utilities at $300. And one of the biggest things for that first year is you're going to have to pay closing costs as a buyer. Usually it's about 1.5% of the purchase price. That's for your loan origination, attorney fees, title insurance is the big one, and then some prepaid. So that number might go up or down based on how much taxes you're paying ahead of time for the lender to hold and pay on your behalf. Okay, so we'll scroll over here, and you'll see that your total cost for year one is about $83,500 compared to $59,000 for renting up here in year one. Partly because of that closing cost of $15,000. So that's going to change significantly. In the second year, it's going to be about $68,000 versus $57,200. Okay, and as you scroll through, you'll see what your total amount you've paid towards that purchase each year. On year 5, you have $361,000 versus $327,000 as a rental. So a little bit more expensive. You've paid a little bit more, but you might have some benefits from buying in this scenario. One thing I want to point out is your mortgage interest deduction. So in year one, it's $37,806. So this figure plus this property tax, this figure is the interest portion of this payment, okay? And when you first start paying, that's going to be a higher percentage of the payment than the principal. The principal would be the other component to this. And when you are in your final payment, 360 months in, it's going to be mostly principal and just a little bit of mortgage interest. So the bank gets paid first, and then you start paying more principal down each month that you own the property. So this number you're allowed to deduct based on a $750,000 federal limit. So this number is actually a percentage of the total mortgage interest that you're able to deduct. The actual mortgage interest was a little bit higher. And then this property tax, you can deduct 100% of your property tax if it's owner occupancy. Okay, so we're going to scroll down to kind of see what the difference is between renting and buying is. So at the end of year one, you paid $73,000. Oh, sorry. At the end of year one, you decide to sell. So when you decide to sell, you have to pay some additional costs: tax stamps, attorney fees, and the real estate commission, which is typically about 5%. So total is about 6% of the sale price. In this scenario, it would be about $63,000 at the end of year one. So if you decide to do that, even with the $50,000 appreciation, you end up paying about $73,300 for owning it for a year. And if you were to rent, you would have paid about $59,750. So if you were to stay or live in Boston for a year and only 1 year, you're probably better off renting if the interest rate is 5% and the appreciation is 5%. But go to year two. So this is a big determination of whether you should buy or rent, is how long you're going to be there for. A lot of people are like, oh, I'm only going to be there for 2 or 3 years. I probably should rent. Well, you'd be surprised how much you can save looking at some of these examples. Year two, you end up paying $68,000. Now this is in total. So this is, your property is now worth $1,102,000 with a 5% year-over-year growth. And you would have paid $122,400 in rent, minus your closing costs, and you end up having a benefit of buying of about $53,000. And you'll see this number will slowly go up. Now this isn't an actual gain. This is just the benefit. This is the difference between buying and renting. You still, with a 5% interest rate and a 5% appreciation, you're still not going to make any money. You're going to be putting that money into the house and paying your mortgage interest, but you will have a $289,000 benefit of buying versus renting. So that's what that looks like. Now, other things to consider are, one big one is return on investment. So if you were to put some capital improvements into the property, this figure obviously could change significantly. If you're able to add a kitchen or a bathroom or paint the house or do something that's required, or you're able to get permitting or something approved that would make the home's value go up. Obviously, that ROI is not factored in here. So this is just apples to apples. If you bought the home, you maintained it, and it's the same home when you go to sell 5 years later. So that's that. Now I want to show you what it would look like with some other examples here. Let me just move my screen down here. So what we just looked at was this: 5% interest rate, 5% appreciation. So you'll see the net benefit of renting is this $289,590. So I did the math on some other examples. So right now in the environment we're in, we're about 5%. If you do an adjustable rate mortgage, you could probably get it a little bit lower. Some local banks are offering lower interest rates, but it really depends on your financial situation and what the Fed is setting for the rates. For instance, in the last 3 or 4 years, we'd be at about a 3% interest rate, and in some areas you see 8% appreciation. So you have a huge benefit of buying versus renting versus this scenario where it's a 3% appreciation and a 6% interest rate, which could happen at the end of this year. So you have to kind of look at these numbers, and one of the big things about all your assumptions is what's the appreciation look like. One thing I found through just kind of putting this all on paper is if you look at this category, this 2-year category, it doesn't really matter what the interest rate is or the appreciation within this parameter because the cost benefit of buying versus renting is going to be a positive return after 24 months. As you'll see, even with a 3% appreciation, 6% interest rate, it's still slightly better to buy. And now this is assuming that you are paying rent. If you were to be in a free rent situation and do the model, so you have no, you're living at your parents' basement, or someone's letting you stay for free, and you broke it down, it looks a lot different. So, for instance, at the end of year 2, you'd be at $119,000 difference if you are to buy. So that is, going to be a huge decision in terms of what your rental rate looks like when you're doing this math. Okay. Now I'm happy to send any of these charts if you're interested. Please send me a message or comment, and you can email me at goodrich@compass.com, and I'd be happy to break this down further for your specific situation. But this is the first part of the series, and I thought it'd be interested to do this exercise. Not only for me to kind of see what it all looks like on paper, but also to educate all of you guys to show you what the math looks like in a rent versus buy situation. Okay, well that is it, and thank you very much.